Well, apparently the bull run for stocks won't last long, at least according to our next guest. Citigroup Scott Chronert is maintaining his 4,000 year-end target for the S&P 500, saying the AI growth move needs to be digested and establishes a stronger first half of 2024 with a 4,400 target. He joins us now. Scott, so thanks so much for joining us. First, let's get into this target. I mean, we are a ways from that right now. What is the trigger that starts that downtrend?
Well, I think going into the second half, we've had this strong rally, let's call it in the NASDAQ names. And, typically when you see a rally of that magnitude, there is some point where you need to digest the move as you're waiting for the earnings revisions to catch up. At the same time, we've gone into the second half thinking that the probability of recession or recession characteristics kicking in a response to the Fed actions over the past year actually would end up putting a headwind on earnings growth potential. So the face-off of those two basically said, look at strong move to start the year. We think it's premature to say it's a new S&P bull market. We look for a pullback to buy into on the premise that as we look at the first half of 24, the picture begins to get much clearer in our view, and so we can get more constructive at that point. So color us glass half full on the equity outlook from here. We're just preferring to buy more aggressively on pullbacks.
I guess, hey, Scott, it's Julie here. What is going to trigger those pullbacks? I mean, listen, we're only, a few days into the earnings season, but so far, if not sunshine and rainbows, it's been pretty darn good, right? We've heard this sort of resilience language being used on the part of CEOs. How do you think that's going to play out as we go through earnings season?
I would say the earnings resilience concept is one that we've been using as well over the past year or so. We used it last year. We're still using it this year to kind of frame out how to think about recession risk. But, I think the underlying all of this is the fact is that the more you run these stocks, the higher the implicit expectations become for companies to deliver incrementally from a fundamental perspective, okay? And we don't doubt that AI is going to be a big thing structurally over the next several years. It's just a question of navigating the shorter term lens where you've had big moves. Will the incremental data points on these heavy NASDAQ weights be sufficient to keep it going? And I think that's sort of the rub. Now, what this does is put a lot of pressure on our view next week, actually, when the bulk of these companies report. So, we'll be checking in on the other side of that, but I think that's going to be the next important set of data points for us.
So, Scott, if your thesis is correct in terms of where the S&P 500 is headed, what is the best defensive position for that?
This is going to sound crazy, but the best defensive position in our view is offensive. And namely, what we've been, suggesting for the past couple of months now is hold those big tech names. Okay, they're running. Again, there's this new AI catalyst that's unfolding here. Got that. Put new money to work on the cyclical side of the market as opposed to defensives. So we're less interested in the traditional defensive calls that worked last year, which we're much more interested in putting money to work incrementally in areas such as industrials, materials, and so forth. And here what you get is, again, our ongoing resilience, earnings resilience argument in those sectors, but you also get the play that should recession continue to get pushed out or eventually become soft landing, ultimately these companies stand to benefit. In aggregate, the cyclicals are up only a couple of percent year to date, whereas the growth component of the market's up 40%. And so we're very confident that for new money, you want to focus on the cyclical side of the market.
And what do you do with tech, Scott? What do you do with growth, that area that has so outperformed? And as you say, we're coming up on those earnings as well.
This is going to sound like a cop-out, but you hold them. Like I said, I do think that longer term, the way we're thinking about this AI construct, and let's focus on that for just a second, is that they're going to be companies that have a very clear revenue and earnings benefit from that as they launch new products specific to this generative AI construct, okay? On the other hand, the broader marketplace and broader economy may not be a revenue earnings beneficiary. It may be a productivity beneficiary. Okay. So essentially, when it comes to these, the mega cap growth names, we're going to see them launch new products. You're beginning to see that already. We want to be on board for that. Again, acknowledging they've run, maybe due for a pause or a pullback, but longer term, we think that it's pretty premature to say it's over for those names. And I would just add the added element that we still think there's room for whether you want to call it performance chasing or other areas of investor money to come into the market. And so, again, it's a hold call. Doesn't sound super exciting. Prepare for a pullback, put new money to work on cyclicals, and prepare for, in our view, a bit more of a coast is clear heading into the 2024 timeframe.
So in your notes, you all say your base case for the second half of 2023 is biased toward a growth slowdown with a lower probability of recession. So how is that the framework that we're speaking of right now? And what sectors are you going in or focused in with that in mind?
Yeah, so this recession timing is the big issue in my mind. Apart from the mega cap growth, AI related surge, recession timing is the big discussion. And, a year ago at this time, our view was that we would be looking at recession concerns in the first half of 23. We saw those on the manufacturing side of the economy, quite honestly. And you see many C-suites going back to Q4 and Q1 reports on the manufacturing industrial side saying, hey, this looks and feels like recession conditions. You did not see that and have not seen that as much on the services or consumer consumption side. And ultimately, when you look at what the Fed's trying to do with its interest rate hikes over the past year, it's really to slow consumption in a way that essentially tames this inflation concern of theirs. So as we go forward from here, the question always comes up, recession. And my response is, why do recessions matter? Recessions matter because they have an earnings influence or impact. You typically get an interest rate response that leads to a valuation resolution in the marketplace. And at this point, what we're still debating is this notion of the Fed slowing economic conditions, getting it fully reflected in earnings expectations before we can begin to talk about the Fed on the other side of the rate hike cycle. So recession timing becomes a big deal. Citi House view has been pushing out. We were, first half 23, then second half 23. Now they're out to the first half of 24. So we have this issue kind of out there lurking in front of us that we have to navigate while we're trying to, also consider the possibilities of this mega cap growth regime shift.
No sweat, right? Scott Chronert, thanks for being here. Citigroup U.S. equity strategist. Good to see you.